this video, I'm going to share 4 of the safest high-yield dividend stocks. These dividend stocks have grown their dividends for more than 30 consecutive years, which is an exceptional track record. But there's more to the story, and I'm not talking about free cash flow or payout ratios, all of which are really important. But these dividend stocks have what I consider unique competitive advantages that have safeguarded their dividends for decades. And one company in particular, I think, offers a very compelling thesis for high growth, excessive cash flow, a very attractive valuation, and a window of opportunity to lock in arguably the safest 7% dividend right now. I'm also briefly going to touch upon the valuations for these 4 companies and where I think they stand. But as always, you need to do your own independent research and thorough due diligence before making any investment decisions. The first dividend stock is Federal Realty Investment Trust, ticker symbol FRT. Founded in 1962, Federal Realty is one of the oldest REITs in the US. It has a dividend yield of around 4% as of this recording and currently ranks as number 488 in the S&P 500, making up just 0.02% of the index with a market cap of just over $8 billion. What makes this company special, however, is its remarkable record of 53 consecutive years of increasing dividends, even during some of the biggest market downturns in the last half century. There's no arguing that this company has withstood the test of time because of one simple advantage. It holds only 100 properties exclusively focused on what's considered the first ring suburbs of 8 major cities. These locations are characterized by high population density, average household income that is about twice the national average, and a high barrier to entry, which means limited competition but high tenant demand. Geographically, it generates the largest percentage of its income from the DC area, and from a property type perspective, mixed-use / urban and grocery-anchored properties generate close to 60% of its income. Now, we can't talk about REITs without talking about COVID-19. Real estate was one of the worst performing sectors in 2020 because of the lockdowns and social distancing. In the first quarter, at the depth of the COVID shutdown, only 47% of Federal Realty's tenants were open and operating. Now that has recovered to 98% by year end. However, rent collection still remains below 90%, which lags behind some of its peers like Kimco at 92% and 96% for national retail properties. It's been lagging primarily because of its restaurant tenants. Restaurants make up 15% of ABR or annualized base rent, the largest share of any category, but 1 out of 4 of them aren't paying. But widespread vaccinations should improve these numbers. In a US consumer sentiment survey conducted by McKinsey in March of 2021, around half of consumers plan to splurge on experiential categories like restaurants and travel once the pandemic ends. In the meantime, this has definitely hit their FFO results. Here's the past 6 years, and you can see that from 2019 to 2020, it declined by 29%. For REITs, you typically don't look at earnings, but something called funds from operations. And this is because you need to adjust for depreciation and amortization, which are deducted from net income. Basically, FFO is a better measure of operating cash flow, which tells you how safe the dividend is. When you add in the annual dividend payouts, the payout ratio has been around 65 to 70%, but it jumped to 96% in 2020. And based on analyst estimates, the payout ratio is expected to remain above 90% for 2021 and then come down to 84% in 2022. In turn, the dividend is projected to continue increasing but very minimally. Analyst estimates expect a 1% increase later this year, a 0.7% increase in 2022, and 1.2% in 2023. This is certainly not ideal given the trailing 12-month inflation rate has paced at 2.6% in March. Looking at its valuation, Federal Realty's price to FFO ratio has fluctuated between 19 to 29 over the years and currently sits at around 24. On the other hand, its closest competitors stand at 17 for Kimco Realty, 17 for National Retail Properties, 13 for Simon Properties, and 20 for Regency Centers Corporation. Over the last decade, equity REITs in general tend to be valued at around 15 to 20. So FRT looks overvalued, but there's a good reason for that. Look at Kimco's dividend history. Its dividend peaked in Q1 2019 and has been cut twice, suspended in Q2 2020, and it came back, but still not at the same level seen since 2019. Look at Simon Properties' history. It suspended its dividend in Q2 and reinstated it at around 1/3 the discount from prior to COVID. Looking at Regency, this REIT has not increased its dividend since Q1 of 2020. So in my opinion, FRT is one of the safest REITs because it has a superb collection of properties. Its real estate portfolio is small compared to many other REITs, but that is advantageous because it is very selective of where its properties are located and it is very good at managing them. So I'm convinced the dividend is safe. The company has curated a strong portfolio to keep growing it as it has been for 53 years. Its dividend yield has averaged around 3% in the past 5 years until the pandemic, but since March, the stock's decline has boosted the dividend yield above 4%. So from a yield perspective, now might be a good opportunity to buy and lock in an above average yield with Federal Realty. However, relative to other REITs, you are paying a premium for the quality of the dividend, and there is the risk of the dividend not keeping up with inflation in the short term. And don't forget that REIT dividends are not qualified dividends, so it might be in your best interest to invest in them through a tax-advantaged account. If you are interested in Federal Realty or any of the next dividend stocks, invest on Webull and get 2 free stocks worth up to $1,850 just by opening an account and depositing $100. Webull is an online trading platform that is commission-free, no minimum deposits, there is no cost to use the basic service. So you get free money just by signing up and making a deposit. So claim your free stock now by using the link in the description, and by doing so, you also help support this channel, so thank you. The next dividend stock is AbbVie, or ticker symbol ABBV. AbbVie is a massive pharmaceutical company that was spun off of Abbott Labs in 2013, but it continues to be credited with 48 consecutive years of dividend growth. As of this recording, it pays out a dividend yield just shy of 5%, which is very high for a dividend aristocrat. But what really attracts many dividend investors to this company is the aggressive double-digit dividend growth rate. In 2020, in the middle of a global pandemic, the company raised its dividend by more than 10%, and that is on the lower end of the growth rate. Back in 2018, it raised its dividend by nearly 41%, which might make you wonder how sustainable this pattern is. To answer that question, you need to first understand its competitive advantage. AbbVie, like most pharmaceutical companies, rely heavily on drug patents. Generally speaking, drug patents expire 20 years after the patent application is filed. During that limited time, companies like AbbVie are the exclusive providers for their groundbreaking drug or treatment as compensation for the cost of research and development and to reward its shareholders. AbbVie's flagship drug is Humira, a multi-purpose drug that is used to treat various conditions like rheumatoid arthritis, plaque psoriasis, Crohn's disease, and more. It has been one of the top-selling drugs in the world for several years, and while that's been great news for AbbVie, it is also a concern. Humira generated $19.8 billion in revenue last year for AbbVie. The company's total revenue was $45.8 billion. Last year, the company relied on this one product to generate 43% of its revenue. Back in 2018, 60% of its revenue came from this one product. So you can see that the company is trying to diversify its revenue sources with other products, which is really important. The patent for Humira expired in Europe at the end of 2018, and you can see that its international revenue has fallen since. In the US, AbbVie has until 2023 before patent protection is lost and cheaper generic alternatives flood the market. When you look at the company's R&D pipeline of activities, it's focused on developing immunology, oncology, and neuroscience products to make up for the anticipated revenue loss from Humira. And this is in addition to the 24 products already on the market. Now, looking at the safety of its dividend based on the payout ratio, here is the free cash flow over the last 5 years, which shows strong growth. And if we add in the dividends paid, you can see that the payout ratio has been 46% in 2020 and about 50% in 2019, so on and so forth. This is a healthy payout ratio for dividend safety. Analysts estimate revenue to grow by 21% for 2021 and slow down to 6.5% for 2022. Not sure why, but I'm thinking it might have to do with the uncertainty in transitioning the company away from Humira. So I expect AbbVie to continue raising their dividend, but growth could slow down compared to what we've seen in the last 7 years. And analyst dividend estimates reflect this concern. It is estimated to grow 6.5% between 2021 to 2022 and decline to 2.4% between 2022 to 2023. Looking at its valuation, AbbVie currently stands at a trailing 12-month enterprise value to EBITDA ratio of 12. I'm avoiding the PE ratio here because AbbVie's earnings are lumpy due to some one-time non-cash charges. When we compare this to its peers, Amgen stands at 13 by the same measure, so a bit pricier. Pfizer, a former dividend aristocrat, stands at 15.7. Johnson & Johnson stands at 16. Looking at the broader industry, the enterprise value to EBITDA has been around 14 over the last 3 years. So AbbVie is a solid high-yield dividend stock with a safe dividend, and it appears to be undervalued compared to its peers and the pharmacy industry. But there is a bit of cloud hanging over the company because it's heavy reliance on Humira. And so I think the company is heading in the right direction, but the next 1 to 2 years will be really important as it diversifies away from its one-hit wonder. The next stock is Altria, ticker symbol MO. Altria Group has grown its dividend for an incredible 51 years as of this recording, with a dividend yield of around 6.5 to 7%. If you've never heard of this company, it's one of the biggest players in the tobacco industry, an industry that is unlike any other in America. Before I go further though, many investors have strong objections to investing in any company associated with the tobacco industry. There are also investors that argue that the harmful effects of tobacco have been widely known for a while, and at some point people need to take personal responsibility for their own actions. Whatever your stance is, my intent here is to simply lay out the facts about the company so you can decide what to do with the information, if anything. I find it fascinating what this company is going through, and I think investors can take away valuable lessons from it even if you don't agree with its business. I mean, this is a company that has consistently grown its revenue and its free cash flow in the last decade, while the percentage of adults who smoke has fallen almost every year from 42% in 1965 to 14% in 2017. And furthermore, the total number of cigarettes sold declined by 66% since 1980. So how is this company still in business, much less paying a safe dividend? You might be thinking it must have other businesses that keep it afloat, but strangely enough, that's just not true. Altria's revenue sources can be grouped into 3 segments. There's the combustible tobacco portfolio that consists of the traditional cigarette brands you see here on the left. There's a non-combustible brands here listed here, and there's a non-tobacco segment which consists of ownership stakes in wine, beer, and marijuana companies. When you look at its net revenue, its tobacco products generated 88% of total revenue over the last 3 years. Altria is still heavily reliant on cigarette sales. So how is this company pulling this off? Well, there's 3 drivers. First, this chart is a bit misleading because it doesn't account for population growth. In 1965, the US population was just shy of 200 million. 42.4% of 200 million is 85 million smokers. In 2017, the population was 325 million. 14% of that is 46 million. So the smoking population really declined by only half over the past 50 years. Second, cigarette prices have skyrocketed over the years as sales plummeted. And so the price increases have more than offset the loss of volume. So how is this possible? Aren't cigarette companies supposed to be competing for customers? Well, there's several factors at play, which leads to the third reason, and that is industry regulation. The historic Tobacco Master Settlement Agreement of 1998 essentially turned the tobacco industry into an oligopoly, with Altria controlling more than 50% of the US market as of 2016. There's little incentive to compete because tobacco companies are severely restricted in selling and marketing their products, and the damages the tobacco companies pay to the states are based on market share. This, along with other aspects of the agreement, makes it virtually impossible for new companies to enter the market. So that explains the surprising growth, stability, and security of Altria's revenue. But there's another side to the business that makes Altria a cash flow machine. This is showing the capital expenditure the company has to spend to maintain the business. Comparing this to the cash flow from operations, it costs less and less to operate the business, which means more cash to pay out dividends. And this makes sense. Tobacco volumes have been declining, so CapEx is growing less than cash flow because there's less manufacturing costs, less labor costs, and along with virtually no marketing expenses because it's prohibited, the overall costs of running the business keep coming down. And so here, free cash flow, or FCF, as a share of revenue has been going up from 21% in 2011 to a staggering 39% in 2020. Now, the dividend payout ratio based on FCF has been around 60 to 80% the last few years, and this is about in line with where management wants to be, around that 80% mark. Analyst estimates project the dividend to grow by 4.7% this year, 5% in 2022, and 5.9% in 2023. Again, not surprising given the cash flows we've seen. From a valuation standpoint, Altria stands at an enterprise value to EBITDA multiple of 10, which is on the low end historically the past 5 years, when it was at a high of 16.5 back in 2017. Which we'll talk about in a minute. But how does this compare to its peers? Here's British American Tobacco, ticker symbol BTI, and it currently stands at 8.5 for enterprise value to EBITDA. Here's Vector Group valued at 10, similar to Altria, And finally, here's Philip Morris International, Altria's much bigger international counterpart with a multiple of 13.3. So relative to its peers, Altria seems to be fairly valued at this point within the industry. The company does recognize it has to position itself away from the slowly declining smokeable product business. It can't keep raising prices forever. So it promotes the Moving Beyond Smoking initiative with a 10-year vision to transition adult smokers to a non-combustible future. Non-combustible future refers to converting smokers to oral tobacco, e-vapor, and heated tobacco products, which based on 2020 revenue make up around 9.7% of the company's portfolio. But this transition has not been smooth sailing. For example, back in 2018, Altria bought a 35% stake in Juul, an e-cigarette company worth $12.8 billion near the peak of its valuation, before the company imploded due to its widespread usage by underage youths, triggering a massive public outrage and numerous regulatory and legal actions against the company. As a consequence, Altria had to write off $11.2 billion in impairment charges due to the disastrous investment. Around the same time, Altria also dabbled into marijuana with another poorly timed investment into Cronos, a 45% $1.8 billion ownership stake that did not pan out as expected. These poor decisions to pivot towards non-combustible products might explain why investors punished the stock price over the past few years, but it doesn't reflect the state of its core business. Despite these stumbles, Altria's fundamentals look healthy, and it still has time to transition away from its legacy business while paying out a very safe dividend. The next stock is at&t, ticker symbol T. I don't think this company really needs an introduction. It's arguably one of the most popular stocks these days with dividend investors because it currently offers a juicy 7% yield for a stable blue chip company. However, some would argue that this is a textbook example of a value trap. Its stock price has been pretty stagnant the past year, and if you step back further, it really hasn't moved much in the last 2 decades. When you compare it to the S&P 500 in the last 5 years, the returns have been dismal. Negative 23% versus 98% for the index. And more recently, as of Q1 2021, for the first time in company history, at&t kept its dividend frozen for more than a year. But despite these setbacks, I remain bullish about at&t and the safety of its dividend. I'm going to walk you through the financial statements to build my case, and I think the numbers speak for themselves. Let's start with its revenue and earnings. Its revenue over the last 10 years increased by an average 4.6% annually, excluding 2020. And its EBITDA growth was higher at 6.2%, which indicates its profit margins has grown over the years. So it's almost like Altria in that at&t is a dominant player in a mature industry, except people don't die from using its service. From the cash flow statement, the company generated $43 billion in cash from operations last year, minus capex, and free cash flow was $27.5 billion. It paid out just shy of $15 billion in dividends, so we have a payout ratio of 54%, which is really safe. When we do the same math for 2018 and 2019, we get 60% and 51% respectively. And real quick for 2021, management projects a ratio in the upper 50% range with $26 billion in cash flow. But going back to the statement, if we look further down, most of the remaining cash then went towards debt payments, which came out to $10.9 billion. So let's talk about this. at&t's debt is the biggest concern most investors have about this company. Its debt to EBITDA ratio is around 2.9 as of the end of 2020. Based on the Corporate Finance Institute's recommendation, any ratio less than 3 is considered acceptable. Ratios higher than 3 or 4 is a red flag. So at&t is right on the edge. Now, I'm going to propose to you why the debt concern is overblown. The company has $155 billion of debt on its balance sheet as of the end of 2020. But the size of the debt isn't the issue. What really matters is, can the company service its debt with the free cash flow available after dividends? Stefan Redlich over at Seeking Alpha wrote an excellent analysis in late 2020 that addresses this question, and I'm going to summarize his findings here. I will link to his article in the description, and I highly recommend reading it. The first key takeaway is this: that at&t has been actively refinancing its debt in the current low interest rate environment and has been pushing out its debt maturities further out at rock bottom fixed rates. In Q1 2020, 37% of its debt was maturing in 5 years or less. By Q3, that share shrunk to 18%. So a big portion of its debt has been refinanced decades into the future, which is irrelevant in the short term. What really matters is the debt maturities within the next 5 years, which comes out to $29 billion. The second takeaway is that short of some unforeseen catastrophe in its core business, at&t should have little problem paying off $30 billion in 5 years. If its cash flow, capex, and dividends from 2020 remain unchanged through 2025, it will have accumulated $62 billion in excess cash, so it could pay its 5-year debt obligations twice over and still have cash remaining. And there's no doubt that its core business in the communications segment will remain a stable cash cow because first, it makes up 79% of operating revenue, half of which is attributed to its mobility subsegment or wireless services, which saw subscribership jump by almost 9% from 2019 to 2020. Second, the business is an oligopoly with only T-Mobile and Verizon competing for the same customers, and the market shares have been really stable. Now, what makes me cautiously optimistic about at&t's growth prospects has to do with its Warner Media segment, which currently generates less than 20% of revenue, but embedded in there is a new HBO Max streaming service, which launched last May and was panned by critics as confusing, a disaster, the worst streaming service by acclaimed director Christopher Nolan. But it slowly came around and was able to hit its initial subscriber goal 2 years ahead of schedule with 41.5 million by the end of 2020. But more importantly, the streaming service is getting better engagement with viewers under 35 that HBO has traditionally struggled with, and has been able to do so with generally higher pricing compared to other streaming services. And it's introducing an ad-supported version of HBO Max for customers that are more price sensitive. Warner Media plans to expand the service to 61 other countries by the end of this year, raising its subscribership projections to 150 million by 2025. So this is all promising, but at the end of it, HBO Max is only expected to grow home box office revenue by just $8 billion. Let me remind you that at&t is a telecommunications giant with 2020 revenue that exceeded $170 billion. It doesn't move the needle a whole lot, but it is quite possible that subscribership will grow much faster than anticipated, as it already exceeded expectations in less than a year since launching. I think it speaks to the valuable and exclusive content library and new blockbusters coming to HBO Max. In the meantime, you can collect a tempting 7% dividend at a very attractive valuation. at&t is right now trading at an enterprise value to EBITDA multiple of 8, and it's been roughly in the 7 to 9 range in the last 5 years. Comparing this to Verizon, it stands at a mid-7 multiple, so slightly cheaper. And if you look at T-Mobile, it currently stands at an 11 multiple, but I think it's not as close to an industry competitor as Verizon. But regardless, given the stock market is at valuations north of 14, an 8 multiple that generates a well-covered 7% dividend is, I think, a pretty good deal. If you found this video valuable, be sure to hit that like button down below, and don't forget to hit that subscribe button and hit that notification bell so you don't miss out on any future videos. Thanks for watching, and I'll see you guys next time.